Now we're live already. I think we got 2 more minutes. Let's wait until it's really time. One more minute to go. Cool, we're live already. For anyone who's joined already, we'll wait for a couple more minutes so we allow everyone to join. And I think, 1 or 2 minutes past 12, I hope everyone is in, and then we actually get going. So take a drink. It's going to be a sit of around, I think, 45 minutes, and then we have another 15 minutes where we can ask some questions, etc. So definitely stay tuned, grab some water, and see you guys in a bit. Cool, I think we're going to go in a little bit. See, we're live already. Give it 1 or 2 more minutes, and then we kick it off with the webinar about like what you must know about CEX listings and market making. It's going to be an interesting one. I mean, a little teaser. We touched upon this in the previous one, what exchanges to pick. I think especially this one, delisting requirements, because there have been a lot of projects actually getting delisted. They go into assessment zone, as you can see here on MEXC, but every exchange has an assessment zone. This is the place where projects and people come, where they need to improve the liquidity statistics in order to actually stay listed on the exchange. Outside of that, we go into token payments. So how does that work? Where does the marketing budget go that is paid on CEX listings, which is an interesting one. It officially should go to marketing, but we sometimes have our doubts on where that is actually going. For now, 1 more minute, and then we get going. In the meantime, I'll open up the section here, the comment section, so we can actually have some questions answered at the end. Cool. I think we can start. Let's get it going. Welcome all. Some of you might have joined the last webinar, which was a great success. Today, we're going to talk about what you must know about CEX listings and market making at the same time. I think very practical for projects, but also if you're a VC founder or advisor or tokenomics advisor, I think we as a market maker get a unique insight into these CEX listings. We manage them upon launch, so I think it's definitely useful information to know when you're advising projects as well. So what we'll go into is, again, which exchange to pick, heavily go into delisting requirements, but also listing requirements. What does it take to get on an exchange? The real value of a listing, how you save money on listings, and what about token payments that are officially going to marketing, but we'll have to see where that actually goes. Then an image here of the assessment zone. This is where projects often go into if they don't care about market making after they get listed. And eventually this leads up to a delisting process as well. So how do you stay out of this? So we're in the room, projects, VCs, accelerators, listing managers, even competitors I saw, and exchanges. If you have any questions, post them into the live on the LinkedIn, because at the end of the webinar, we'll actually go into that. So let's kick it off. I think an important statement is exchanges give you an audience. You will have to activate them. What we mean with that is that the exchange often is seen as this place where they will take care of the volume. But out of experience, for most projects, unfortunately, and on most exchanges, you will still have to make sure that you activate them. They have an audience. They make sure that there are people that can buy. You got to incentivize them to actually purchase the token still. Unless you go on Binance, it creates a lot of hype and attention. They bring volume, maybe Bybit, OKX, but most exchanges is actually a place where people can purchase it. You still gotta, with marketing and KOLs, etc., make sure they actually want to purchase. So an image you guys have seen before, and I've updated it slightly with more exchanges about all the exchanges and organic demand and how easy it is to get listed on these exchanges as a starting point. So I think everything until MEXC here, they have a fixed fee for listing, which goes for MEXC 30K USDT, 30K worth of token payments that goes to marketing, is what the listing fee is. It's super easy to get listed until here because there are basically no requirements except for some legal things. I think also if you're looking to work with a listing agency, I don't think there's a huge benefit of working with an agency compared to just reaching out to a listing manager when it comes to listing on anything up till MEXC. Everything when it comes to listing here probably takes less than a week, unless you need to do custom integrations because you're layer 1 and you need to make sure the deposits and withdrawals are possible on that exchange. The moment you go above this and want to get listed on exchange like KuCoin, Kraken, Bybit, OKX, you need to have, real good connections. So it's often a market maker or a listing agency that has those connections, which will make it easier to actually get those conversations in and get listed there, but also lower your listing fee. So generally speaking, when it comes to, working with agencies, up till MEXC, you don't need it. Anything above that, it might make sense to actually work with an agency, especially when you want to go on like OKX and Bybit. What we have seen from experience, because we have clients that are on like all of these markets here, and then we know exactly what is the relative volume on each of these markets organically. And what we found is that some exchanges actually have really good organic volume. And especially if you compare that to the price that you pay for it, one of them actually always stood out, which is MEXC. That's often the gateway and the entry point for most exchange, for most projects. So when it comes to MEXC, you pay 60K in total. We rate the organic demand to 7.75, which is even higher than a BitCat and a Gate, is what we see. Compared it to the pricing, and this is different from project to project, of course, but at least when I look at the organic demand, the volume is quite equal. Sometimes Gate shoots a little bit above, sometimes BitCat, and sometimes MEXC, but it's somewhat the same. KuCoin has more volume for sure than an MEXC market, but not by far, where I feel like the cost-benefit trade-off for most projects doesn't make sense to only go on KuCoin and skip MEXC. MEXC is often a good stepping stone. When it comes to listing fees, we've seen three things. We've seen USDT only. You just pay 60K, 100K, 200K USDT, and that's it. We've seen USDT plus tokens, typically MEXC model, 30K USDT, 30K worth of tokens. One thing to keep in mind is that the tokens will be sold. Either this goes through airdrops of the users on the platform that will sell it, or to be fair, I think that the exchanges might sometimes just take it themselves and start liquidating that. The last one that we see, and this is really where you go to like top tier exchanges like a Binance, they ask for a percentage of supply, or OKX as well. Tokens will be sold as well. If you do this, even with exchanges, see if you can get a lockup on these deals as well, where it's fine if they take a percentage of supply. But two things to focus on. What is the vesting on those tokens so they don't dump straight away? Secondly, is you got to make sure that it's not a crazy amount in terms of dollar value. If you're launching at $100 million FTV and they take 1% of the token, that's a $1 million price to get listed, which might be fine on Binance, but is not fine enough on an exchange like a Bybit, in my opinion. So definitely think about the dollar value of these tokens, not only the percentage of supply. So what does it require to get listed? And I've taken some screenshot of literally, this comes from Bitmart, the requirements to get listed here. And as I said, these are standard templated requirements. If you want to go on Gate and KuCoin, they have other requirements. So generally what it looks like, you need to have a good spread, is what they say. You need to have more than 30 orders on the book. There needs to be more than $3,000 within 2% of the price. And if you watch the previous webinar, we dove into those numbers. You need to maintain this, or the market maker needs to do that. They also say within 5% of the price, there needs to be $5,000, and within 10% of the price, $10,000. So this is just a way for them to maintain that there's a healthy market. And I'll go into that in a bit. So liquidity is a big part that you need to maintain the moment you want to get listed. And you sign an agreement that looks like this, where they monitor this every single day to make sure you meet those requirements. Then the second part is the funding of the account. On MEXC, you need to put 30K USDT, 30K worth of tokens on the market making account, and you cannot withdraw that for at least a month. Bitmart here, an example, is 15K USDT, 15K worth of tokens that need to be on the market making account, so they know for sure that you can have those, meet these liquidity requirements. After you cannot withdraw them even, you might be able to send them to a sub account, but you cannot withdraw the tokens from the account even, or the USDT. So when it comes to listing requirements, a couple KPIs they put in place is funding. There needs to be minimally X amount, minimally 2% spread. The depth, they put 2, 5, and 10 depth requirements in place, where for I think the lowest exchange is probably like 1K and 2% depth. Then when they talk about volume, even where they say you need minimally 50K in volume on a market, otherwise we might delist you. And I think this is a little bit of a, I understand the requirement, but I think this really imposes wash trading that happens for projects, because otherwise they get delisted. Some exchanges even put 150K in volume as a minimum requirement. What I don't like about it is that most projects don't have suddenly 50K in volume, although it sounds like a very little amount, and every project has it. From experience, we know that a small or mid-cap or just starting up project doesn't suddenly have 50K in volume on a daily basis. The other thing they focus on is number of orders. So you need minimally on the sell side or buy side, let's say 30 orders on the book, and they monitor that, and your market maker is responsible for that. Lastly, you need a market maker lined up, otherwise you're not allowed to get listed. Simply because they know if you don't have a market maker, there's no way you're going to be able to meet those requirements, because liquidity doesn't come organically, and exchanges know that. So do keep in mind these things when you consider a listing, and when you sign an agreement, most of these KPIs are actually in there. So this is for the template, exchanges up to MEXC. Agreements are standard, pricing is standard, funding is standard, but what about the bigger exchanges? Well, in order to get on the bigger exchanges, it depends on if you're already listed or not. If you're already listed, what they look for is you need to have solid other listings. What I mean with that is you need to have solid liquidity, 2% depth. There needs to be solid volume, or anything that is indicating that you have real hype and real volume on your market. Therefore, they look at DEX volume. Because if you talk to them, they often will come back to you and say like, hey, you need more volume on the market. Then the project will do wash trading and they say we have enough volume, and then they still don't get listed, simply because the project knows that the exchange knows it's fake. You got to make sure that everything that you do indicates real volume on the market. That is primarily done with DEX volume, good liquidity, and then X following and hype, and how many yapping you have around your project. If you have enough, like Trump did in the beginning, right? When they get listed, they list you for free. If you don't have it as much as the Trump token, but to a certain extent, you get better terms, so you pay less for your listing. If you're really, a project that simply doesn't qualify, they're going to charge you a crazy amount for listing and trying to fuck you over, so to say. Well, you can still take that, but be smart enough to not invest 600K in a listing if it just doesn't make sense. Again, an exchange gives you an audience. It doesn't activate you. You still need to activate it yourself. Lastly, what they care about is, especially for if you're a new token, they care about whether you're able to bring new users. If you have enough hype, like Trump did in the beginning, they know that if they list you and you're one of the few venues they're listed on, you will actually bring users to the table. So focus on proper liquidity statistics. We want to get on top tier exchanges, proper DEX volume, and this is one of the biggest ones. There needs to be hype and good following on X. And then whether you can bring new users to a platform is what they care about. You see it this way, right? They make money in two ways: either a listing fee or the volume and the fees generated from the actual trading volume on the market. So if you have enough volume, they don't need to make as much with a listing fee because it's covered somewhere else. If you have no volume or no projected, enough volume, this goes into millions, they will just have to give you a higher price for the listing fee to offset that risk. When it comes to the KPIs, we've seen one specific exchange. They had a launchpad offer, and what they put in there is that if you then launch with us and you get listed on our exchange, the price cannot drop below the launchpad price where people bought in. So in some agreements, there are certain rules that price cannot drop by more than 20% in a given week or a given day. I think those things are somewhat fair to prevent rug pulling, right? But make sure there's no unrealistic price guarantees on listing requirements, like keeping the price above the launchpad price. Something to summarize is better liquidity means better trading experience, means more volume for both the exchange and the project. So there is a need to not only get listed, but supply it with enough liquidity. That's why these requirements are in place, but also that's why you as a project should care, because more liquidity means more volume on a market. Otherwise, people will come to the exchange and they cannot trade. What an exchange wants is that it has so much liquidity on the book that you're the best exchange to go to trade this asset. How can they make sure this happens? They got to make sure this happens with the actual requirements that they put on the book. So you sign something, you have to oblige to it, otherwise they can delist you because it hurts their reputation. Up to MEXC, they don't care, but the moment you start to go on BitGet especially, they're very hard on these requirements. And if you don't meet them, they'll just get you off the platform. Because they want to have a reputation that if you go on BitGet, you get good quality liquidity for every single token. That's why they have these hard requirements. So what does a listing process look like? In the meantime, I've heard that putting a call to action in the middle is better than putting a call to action at the end. So in case you haven't followed us and we talk more and more about this, give us a follow on X, also on YouTube, and also on LinkedIn. This is where I talk mostly. This is where the company talks mostly, and this is where you can actually see, the webinars, but also short form content of us. So give it a follow. The process, the moment you're actually agreed to, get listed, it is pretty basic, and I think the juice comes after this slide. It's the agreement itself. You need to, come up with a listing price, payment. Then there's a KYB that you need to do to make sure that you're actually a legit company. And then I think more the technical part happens. There's an integration needed and information to make sure that deposits and withdrawals are actually possible on the platform. Sometimes what happens if you're a new layer one in your own chain, they need to do a whole integration to make this happen. So the listing fee is way more expensive. On the other hand, there's marketing that needs to be done, meaning they need approval on some text that they'll put out on their website, on their X. They probably need your logo, etc. So this is more of kind of like a templated thing that needs to happen. If you're launching on Base, on Ethereum, the integration is pretty simple. Probably send some information over and they are able to make it happen, do some test transactions, and that's done. Next step is you actually got to make sure you have a market maker arranged. Whether that's a loan option or whether that's a retainer model, that doesn't matter. If it's a retainer, you got to make sure that you also fund it with enough. So the moment you have done the KYB, you're able to set up an account as well with the respective exchange. You got to fund it properly before you get listed. They'll check everything if you have enough funding on the account to actually provide liquidity. And then, there's a specific date arranged on the listing price. So what is the opening price of the asset? And then the actual listing date. And that's where it becomes interesting because that's also where our work kind of really start with the algorithm. So how do we manage that part? One of the first steps is actually determining a listing price or an opening price of the asset. So this is from a listing that happened yesterday. The opening price was very low, and the fair value price where the market really wanted to go or started is here. So let's say you have an asset that is already traded at, let's say, $1 on average. They put the opening price, so the start of the candle, let's say 40, 50, 60% lower. And that is what really generates this first initial green candle. What this means is that it opens here. There's no trades happening that are in between this section. The first trade is happening here. This is where a market maker starts providing its liquidity. Most exchanges suggest a opening price to be 30% or 40% below the current price of the asset, simply because that creates a candle like this. I'm not a huge fan of it, but it's not that important. We often say 15% is enough. You don't need that huge candle. Let's keep it realistic. We don't have to, trick retail into thinking that there is a 600% price increase on an asset. So whenever you see this on a launch of a token, doesn't mean there's enough buying demand, but it does mean that the opening price is lower than where the liquidity is placed. So actually 30 to 60 minutes before the launch, the market maker is able to fill up the order books already. Why is that important? That's because the moment the market goes out, opens up to the public, there needs to be orders in the order book so people can actually trade. Otherwise, it's a really bad trading experience. On 90% of the exchanges, we are only able to place sell orders on the book. No buy orders yet. Sell orders because first people buy on the market, price goes up. But that means that the moment the market goes live, very quickly we got to make sure we fill up the buy order book as well, that if there's any selling, there's actually a counterparty to it. So we fill up the order book 30 to 60 minutes before the market actually goes live. We place buy orders. So there's one other thing that happens with launches is that withdrawals are not open straight away. You can deposit tokens, but you can never withdraw them for the first 24 hours. So actually what we see happening here is that because you can't withdraw tokens, you cannot do arbitrage effectively. You cannot buy tokens on the newly launched exchange lower, take them out and sell them higher on the DEX. That's why a big part of the job that we need to do is we cannot fix this arbitrage always because there's too much selling pressure. So we got to fix the arbitrage while at the same time also focus on that we don't spend too much dollars upon launch. Sometimes I feel like this is just the time that the exchange has to offload tokens themselves. And it is really strange that it just doesn't open up straight away. Deposits are possible, withdrawals are not possible on most exchanges 24 hours within the launch period. After that, it is just the normal market making and market management that we need to do. Often in the first 24 to 48 hours, there's significantly more volatility. The volatility dies down significantly after that moment, and it becomes more normal market management. So what else do we deal with at launches? First of all, we see here is a screenshot of all the balances on a specific exchange over time. So a lot of it is balance management. We got to make sure that there's always enough dollars on the account so we can place buy liquidity so people can actually sell. At the same time, it's also making sure there's enough sell liquidity on the book so people can actually continuously buy. If there's too much selling pressure, this is really what most of the launches are about for us, is how do you manage buying and selling pressure? We often see a lot of buying activity initially, and then it's continuous selling. Unfortunately, most of the crypto charts have an initial push, and then it slowly starts to trade down. Well, as a market maker, you should have buy liquidity on the book to support those prices, of course, but sometimes you don't have enough dollars from a project. So this is really what we're playing with. It's like understanding tokenomics beforehand, so we know what selling pressure comes to TGE, from who, where did they buy in, and what is most likely going to happen with the tokens that are actually, upon sale, the flow that can actually be sold. Managing this together with the clients is a lot of work, to be fair, but especially during the market times is very hard to manage. Often we're still in a call with these guys, for hours right at launch, so we can quickly, call each other, jump back in the call, unmute ourselves, and have a chat and see what they want us to do. And then this is the biggest thing, of course, that we're able to continuously create a healthy market with a healthy amount of buy and sell liquidity on the book so people can easily trade. Not $100, but easily multiple thousands of dollars at a time. So 3 things we deal with: balance, selling, and buying pressure as well. And then the biggest part is with the end goal of creating the healthiest market possible, which drives adoption for the project. 2 things we live by, I would say, is let the market be the market as much as possible. Of course, if someone is trying to manipulate the price and push it up significantly, well, there's a role for a market maker also to do what's best and healthiest for the market, which is not supporting the price to go even higher, right? So that's where we need to find a balance between, let the market be the market and what is healthy and a healthy market for most people to interact with. The other thing that we found is the hardest thing to deal with is unlocks and bad vesting schedules are the killers of most projects. Often we come in, look at the tokenomics. We've not been involved in any of them. And there's just bad deals being made where airdrops have been done too much and we don't have enough liquidity or we don't have enough USDT to actually absorb all of the selling pressure that's going to come on the book. So they made some mistakes and bad deals along the way. It's our role, it's our job to then still manage it, but ideally we come in sooner, like 2 months before when they're actually starting to make these deals. That is also why we're looking, while we're building up an advisory part where we can actually get involved way sooner and do a full successful launch, rather than, there's another party that has done something and we have to work with a little bit of something that's broken. But the biggest thing is unlocks investing, or the schedules are the killer of most projects. A slide that we had before in the previous webinar. So how much funding is needed actually? How much dollars do you need on the account? So a lot of it has to do with exchange requirements. So if the exchange says you need 5K on the book and we need $30K on the account, then that's what you need minimally. And then the second part is, how much depth do you want as a project that is solid? An example, very much out of line, but Bitcoin needs millions of dollars. Like if you get that token listed, although the exchange requires minimally 5K, you're not going to put 5K on the book. Bitcoin needs millions. That's what I mean. We advise on how much we think based on the size and the reputation the project has, how much depth they need on the book, and how much funding is therefore required. And a big part of that as well is the tokenomics. The more selling pressure we can expect, the more USDT we actually require as a market maker in order to actually create a healthy market which can be supported, which prevents huge price drops. Shown this one before. This gives you an indication of if you want to attract small retail, you can have less than $1,000 on the book. You need minimally 7.5K in dollars and tokens. If you want to attract small investors, you need minimally 2.5K on the book to 7.5K. You need 30K in dollars, 30K in tokens. If you want the biggest investors on board, you need 50 to millions of dollars on depth on the book. You need inventory of minimally 200K to millions of dollars. So I just want to illustrate that with more depth, you can attract more investors or larger type investors, get bigger deals done. But on the same side, you also need enough more inventory on the market making side, balances. A statement about delisting, actually, because we even recommend some projects to get delisted from exchanges, and that's with a purpose, and I think it's a really good learning for a lot of projects and an approach that they can take. Because what we believe is not about quantity of listings, it's about quality of listings. I've taken 2 screenshots of 2 different projects. One which is listed on only Gate with a tight spread, a lot of depth, meaning one individual can buy $36,000 with one single market order without having a real issue on the price or a lot of slippage. While comparing this to this market, to these guys that are listed on, what is it, like 10 exchanges, where there's market making that needs to be done on 10 exchanges, where someone is unable to buy even $2,000 of this token. I bet that if they would delist from some exchanges here and focus on one only, or 2 or 3, of course, they will get better quality liquidity, which makes better quality listings, rather than focus on quantity and just keeping it up here. You need at least 1 or 2 places where people can buy massive amounts and the rest can be maintained. So what I would recommend projects like these is consider some delistings of projects, take those funds, put it on the top tier exchange, the best listing you have, and then make really solid liquidity where if an investor comes on board, they actually can purchase there. Here are some real screenshots of messages that we've received or agreements we have seen of counterparties of exchanges on when they get delisted. Some messages. So here we have delisting requirements for Bitmart. What this means, if you're not meeting them, they have the right to delist you. The one on the right is from BitGet. Let me walk you through some examples of what these delisting requirements mean and what you need to maintain in order to stay listed. So spread, quite obvious, cannot be over 1.5%. There needs to be at least 30 orders on the book. In each direction, so both buy and sell sides, need to be at least $20,000 on the book at any given point. Right now, this is 30 on BitGet. That means you need minimally 30 to 50, 60K in balance on the account. The volume cannot be more than 200K on market making trading. I think this is preventing wash trading, but there needs to be at least $50,000 in tokens in volume. This is BitGet, by the way. The price shall not decline by more than 20% within a month from listing date. Of course, you cannot guarantee that, but I think they just want to prevent, rug pullers here. And there needs to be enough liquidity, meaning enough funds on the book, actually, but also making sure there's enough funds on the account. We have them here as well. Another example, liquidity needs to be minimally 5,000 within 2%. Enough, at least 30 orders on the book with 30K in total on both sides on the book. Either this is the market maker that provides that or the project itself. Here, it cannot decline by more than 30% in a given day, which is quite fair. And then this is a very interesting point 7. The project warrants the liquidity available on the platforms shall not be worse than any other exchange. And this is what I mean with what exchanges want. They want that if someone comes and trades a token, they come to their exchange, in this case, BitGet. BitGet wants to be the best exchange possible when it comes to liquidity. Of course, this is a little bit, you cannot always warrant that and make sure that it's always the best listing, but at least they put in an agreement to make sure that they have the right to, actually make, prevent you from dropping their liquidity. Here's one from MEXC. A message that they are receiving, if things are not okay. And there's 2 very interesting ones. The average holdings of a project token are less than 50K. What that means is that collectively, all the accounts on MEXC don't hold more than 50K worth of tokens on the account. That is not enough. What they also focus on is not in this one, but there needs to be at least 50 individual holders of the token. So what they want is there needs to be minimally 50 holders of the token on the account, on the exchange, but also they collectively need to hold more than $50,000 on the account. This is just some other, and every exchange has a specific thing, so it's really important that you dive into it and clearly understand it. Can I actually meet those? And not can I meet them today, but what if there's a lot of selling pressure? Can I still meet them at that point? Because if I run out of dollars, can I supply it with new dollars to still make sure that I actually meet these requirements? That's why I think spending too much on a listing is not great, because you can never, spend, readjust or reapply a little bit more liquidity. If you're not meeting these, exchanges put you on a so-called ST warning or assessment zone, and this is the one from MEXC where if someone wants to trade the token, they get this warning before. And most exchanges have something like this. They get an ST label, where that's kind of like a pre-stage where liquidity needs to be fixed, otherwise they actually delist you. One thing we found, and that's maybe with misaligned incentives, and just it's not fully true, but I think that's the mindset you almost should have, or when you get listed on product, because exchange only care about you before the listing, because 90% of their revenue comes from a listing fee, 10% maybe from the volume, and they just don't care about you anymore afterwards. They've made their commission, they've made their money. So they're also sometimes pretty ruthless when it comes to delisting. It's like, well, we made our money. It's your job to keep these things. We have the right to delist you, but also we have the right to delist you because otherwise the quality of our listings goes down, and they want to warrant that. So keep that in mind, that you got to keep them happy at that point. And you do that by making sure there's either enough volume or you're just meeting those requirements, so they have no right to delist you. We're actually almost at the end. And there's one more thing that I wanted to say when it comes to picking the exchanges, is that I think there's a audience overlap within exchanges often. What I mean with that is that users that are on Gate are very similar to users that are on MEXC and KuCoin. There's a huge overlap, I guess. So you don't need to go on 20 exchanges and to really expand the audience. There, you got to be on the right exchanges because the only benefit you get from getting listed on, KuCoin rather than Gate and MEXC is this little bit of unique users that are only on KuCoin. And there's definitely some. But again, then you also got to activate them because you only get more audience, but you still got to make sure that they actually purchase. So you got to find them as well. So keep that in mind, that the additional value of a second or third or fourth listing is not as much as your first or second, because they have a huge overlap when it comes to listing. Same as, like, I think the people that have an MEXC account, they probably have an Albank account already. So why do you get both? What is the additional value you get from that? Because you'll pay more for market making each month. Secondly, you need to lock up more funds. It's better to have one solid listing rather than two mediocre ones. So then we're a nice 38 minutes in. Wanted to, before we go to the question round, make sure that we cover, at least for everyone who's in here, what they also can get out of Enflux. So for listing managers, we have the partner program. That has really blown up quite a lot. We have more than 50 listing managers in there that can earn commissions on referrals, on market making and OTC. Of course, for projects, most obvious is, like, of course, we can do market making, but the other thing that really helpful is liquidity audits. We audit token loan option models. These things are often for free. We don't charge for that. 2-week free trial to really understand how we work. BitMEX free perpetuals listing, flexible OTC investments, and we do tokenomics reviews as well. Like, especially these last servers are just for free, just to help out and provide some value, because what we believe in is at the moment we provide some value, at some point we'll get that value back. Fee for VCs and institutions, we do large-scale, low-impact token liquidations. We do full audits and master classes like these, or on specific topics to their portfolio projects. Exchange Growth Partner Program, where we help exchanges grow, especially early on, with getting them projects. We do market making for a lower fee. And then lastly, we do masterclass at accelerators and project mentorship as well. That being said, if you have any other questions, you can always send them to operations@enflux.io or to our LinkedIn inbox, our socials, and then we go to the questions. I'm putting this one up. This is a QR code that you can go to my my Telegram, actually, where you can ask more questions about market making and OTC. I think for now, if you have any questions, put them in the comment section on the webinar. Julius and Z, who are in here as well, definitely send them over to my Slack if you see them on Twitter, so I can answer those. Let me see. Okay, there we go. Mehdi, if I pronounce it correctly, does market makers make the final form of candles? What does the ideal tokenomics look like? So when it comes to ideal form of candles, or the candles, again, let the market be the market. If the market creates candles, that what create candles is not the market maker that should do it. Again, we're passively waiting in the order book. If other people come and trade, that's where candles are formed. We can put a little bit more or less liquidity on there, of course, depending on how much balance we have on the accounts. That's done automatically with a specific algorithm. It's not that we create candles. Yes, we can, prevent price from really going out of ranges, or from price manipulation to be happening by putting larger sell orders in. But it's not that our role is, in my opinion, to generate a falling wedge so we can get traders on board and all that kind of stuff. What does the ideal tokenomics look like? That's a really good question. I think that should be almost like a whole other webinar, but I think the biggest thing to focus on is launch at a fair FDV, where, and Tony says this really well, is make sure that the profits are not baked into, before the launch. What I mean that if you want price to increase, there needs to be something for people to be interested in. If all the profits are baked in the pre-launch already, everything before the launch, with investors, with airdrops, with the launch pad where people take their profits, there's nothing left anymore, for buying interest the moment the launch is actually happening. And the only thing that will come is selling pressure, and you gotta manage that. So again, the biggest blocker or the biggest threat, I would say, is really all that selling pressure that comes on at launch. And if you can reduce it as much as possible with very long vestings, I think that's where you're set up for success. Of course, longer vestings, you're just delaying, it. You're just delaying the selling pressure that comes on. So you still got to make sure there's enough buying at that point. Otherwise, it will still go downhill. Thanks, Frank. Vinay, everything's recorded. Let me see. Then we go to another question. Some projects don't prioritize on-chain liquidity. What's your take on this? I'm a big fan of DEXs, simply because we're in Web3. The adoption happened on DEXs, so I think it's important to put liquidity on a DEX. The downside is that if you give me 100K on a DEX, you're not going to get a very liquid pool on V2. You give us 100K on a CEX, well, you can get the same quality of liquidity with 50K. So you need to have less inventory, and it means you have more capital to use on other things. So if you're really cash strapped and you don't have enough cash, I understand that people focus less on DEXs, but just from the crypto ethos, I think DEXs are really important, and we should keep that up. Hope that answers your question. Then let me see if there's any more questions. Let me open up the comment section again. Okay, God's will. Let's say a project is already listed in 4 tier 2 exchanges. Is there any benefit of listing of any other top 5 exchanges like Binance, OKX, Bybit, or Crypto.com? Good question. I think so. So especially when you go to these top tier exchanges, that's where I think they have a more unique audience, and they will actually be able to activate users more than if you're on like the top tier exchanges. They don't activate users much. A Binance listing get a lot of attention, a lot of hype by itself that generates buyers. So that's the benefit of it. Well, the only question is, how much is that worth to you? Is that worth 600K, 700K? Or would I be able to spend that 600-700K on anything else and generate more attention than getting on an exchange like OKX? Right? That's, I think, the trade-off that needs to be made. A lot of people think that, well, I'll get on an exchange because then I can build more treasury. To a certain grade of exchanges, you're not gonna, the ROI is negative. Like, it's gonna cost you just as much as it's gonna reward you in terms of more liquidations that are possible. I don't think getting on KuCoin or Gate, which cost like anywhere between like 2 to 600K, you're going to be able to liquidate 2 to 600K more that you otherwise wouldn't. And I also hate it when you actually look at an ROI perspective on an exchange, because the goal is to get more tokens in the hands of users rather than getting it in the hands of people that hold and don't use it. It's all about that adoption part. And if people want the token and have an MEXC account, they can just buy there. Let me see if there's any more questions, most recent ones. Yatin, good question. Can you please explain what 2%, plus 2%, and minus 2% depth and tight spread is in easy words? So let me quickly move to a slide that has it here. So in most simple terms, and then I'll go a little bit more in depth, is how the plus 2% is the amount of liquidity on the order book that is on the sell side. In most simple terms, it's like how much can someone buy in one single market order? In this case, is 36K. Then you have 2% slippage. So the more there is, the more that someone can buy in one single market order without impacting price too much. That means if I have 1.2K, that means I can only purchase 1.2K in one single click. If I have 36K, someone can buy $36,000 within one single market order. So you can attract bigger investors. People can trade larger sizes more easily simply because there's more liquidity. Where plus 2% is how much someone can buy, minus 2% is the bid liquidity, so how much someone can sell with a market order. Both need to be solid because you're not going to buy a token where there's a lot of sell liquidity but no buy liquidity, meaning you can easily buy but you cannot easily sell. This is really the buyability and the sellability of an asset. How much can someone purchase in one single click is the most easy thing to explain it with. Spread, most simple thing is see this as an additional trading fee. You're losing 3 basis points here when you buy and sell. Here you're losing 30 basis points. Here on BitC, you're losing 1.5%. Wider spread means you as a trader lose more value, meaning it's just an additional trading fee. See it as the Uniswap, fee on a liquidity pool. That's somewhat similar. Hope that explains it. What on-chain metric you're watching to find a fair value, such as number of holders, stakers, etc.? That is a really hard one. I think a lot of the valuation is relative these days, where you just look at, hey, what is really the traction? What products are we similar to? What have been the ranges of FD fees that are launched in the past 1 to 2 months? And that's something where we can kind of launch in as well. It depends on how easily you got investors on board. You got to start somewhere. So it's really hard to say. I think ideally I look at revenue or actual users, and that then translates into how much do people actually need this token. If you come on and say, well, we make $6 million in revenue a year, and we launch a token around it with a really strong use case for all $6 million of revenue, people that use it, I think your valuation should be way higher than a product like, well, we have nothing, we have a product but no users. Then you launch with a way lower FTV. But still, it all depends on what is normal in these market cycles and how do they perform. Prefer to be a bit lower in that range, basically. Then let me see if there's any other questions. Yatin, you said, do exchanges have different trading fees for market makers and normal users? The answer is yes. If we are market making on the client's accounts of the project, they often have 0 accounts fees. So maker and taker are both 0, or the taker is a little bit. We shouldn't trade too much taker anyways, except for arbitrage. But yes, there's a difference. If we're trading on our own accounts, so as Enflux and we take the funds in-house, we also have lower fees simply because we trade a lot. So the exchange gives us, specific, fee reductions. But that all depends, and you can get that as well as a user yourself. If you trade a lot, you can get better fees. Well, we trade a lot because we're market makers, and therefore we get better fees as well. Z Julius, let me see if there's anything that you guys sent to me. Yes. Did I hear you say you can be delisted if you have whale wallet holders? No, that's not what I said. It's a. I think this one was touching upon is this one here is if the holders of your token on an exchange, in this case MEXC, hold less than $50,000 collectively, so that can be within 10 users, that can be within 100 users. That means that not enough people hold your token or not enough value, and they are considering to delist you. I think that's what you meant with it. Cool, that's very useful. Z, any other questions from your side that are coming up here? Otherwise, I'll check one more time on the LinkedIn one. Yeah, I see another one. What is your perspective on Hyperliquid as a market maker? What do you think of bootstrapping the initial liquidity on it? What do you mean, like Hyperliquid being the market maker, or just, you know, having the liquidity on Hyperliquid? Because generally we're still providing the liquidity using maybe the bootstrapped initial liquidity on it. Well, the one thing with bootstrap liquidity, and I think every project has bootstrap liquidity because they do, let's say, a launchpad launch. They sell tokens with the launchpad at a discount, maybe lockups. They get dollars. That's going into the liquidity pool. So most of the liquidity is bootstrapped. It comes from somewhere and often comes in the form of like, hey, I give you tokens at a discount. One thing that's then really important is that everyone is looking to profit from that as well. So if you sell tokens 20% discount, 3 months lockup, well, everyone is going to sell until there's no profit left anymore. So I think the same would work for Hyperliquid if everything is bootstrapped. People are looking for a yield. If there's no yield to be made, they'll sell the token, or they get it out of a liquidity pool, or that they put it somewhere else. I think Hyperliquid, what they're doing is great. I like their product. I like DEXs in general, just a place where everyone can trade rather than it being restricted. So I don't know if I'm fully able to answer that question, but this is as much as I have. Feel free to send it over Telegram, by the way. Then I can ask a couple questions to you, and maybe we can dive into a little bit deeper. Let me see if there's another one. I think that's it. Z, checking you one more time. No more questions. Cool, then I think we can round it off. Again, if you have any questions, here's my Telegram. Send them over, or if you think there's any way we can collaborate. Otherwise, I'll see you within a month for the next webinar. Thanks a lot.